All right, today we're going to tackle U.S. tax residency. Now, this isn't just about where you happen to be living, it's an incredibly important legal status with huge financial consequences. And it all boils down to a very specific, multi-layered set of rules and exceptions. So let's dive right in. Okay, first things first, let's just bust a massive myth right out of the gate. Your immigration status, your visa, your passport, is completely separate from your tax status. You could be a non-resident for immigration purposes, but surprise, a resident for tax purposes. And that distinction, as you're about to see, is absolutely critical. So why does this matter so much? Well, the stakes are enormous. You see, if you're considered a resident alien, the US government taxes you on your worldwide income. That means every single dollar, no matter where on the planet you earned it. But if you're a non-resident alien, you're only taxed on income from US sources. That one single difference can change your entire financial picture. So here's our game plan for today. We're going to start with the baseline test, the fundamental rules the IRS uses to establish residency. Then we'll get into the really interesting part, the powerful exceptions that can completely override those initial results. And finally, we'll talk about the ultimate trump card, tax treaties, and a super common but tricky situation called the dual status year. Okay, let's get into the nuts and bolts. The IRS really has two main ways to determine if a non-US citizen is a US tax resident. This is square one. It's always the starting point for any analysis. So the two main paths to becoming a tax resident are the green card test and the substantial presence test. Think of the green card test as the easy one. It's a simple black and white rule. If you've got the card, you're in. The substantial presence test, on the other hand, is the mathematical one. It's all about counting your days in the US using a very specific formula. The green card test is pretty much as straightforward as it sounds. If at any point, even for just one day during the calendar year, you are a lawful permanent resident of the US, you are automatically a US resident for tax purposes. That's it. No math, no other conditions at this stage. You hold the card, you're a tax resident. Simple as that. All right, so what if you don't have a green card? Well, now we move on to the substantial presence test. This is where we have to, pull out the calculator. It's a very precise weighted formula that's designed to measure how significant your physical presence in the US has been over a 3-year look-back period. So how does this thing actually work? Well, you meet the test if you are physically in the US for at least 31 days this year, and a special weighted total adds up to 183 days or more. And here's the formula. You take all of your days from this year, add 1/3 of your days from last year, and then add 1/6 of your days from the year before that. The whole idea is to see if you have a consistent pattern of being here, not just one long vacation. But wait, there's a catch. Not every single day you're physically in the US counts towards that 183-day total. The IRS carves out exceptions for certain people. They call them exempt individuals. We're talking about folks like students on an F or J visa, or trainees and researchers on a J or Q visa. Basically, the law sees their reason for being here as temporary by nature, so their days don't count. Okay, now this is where the analysis gets really interesting. Even if you do the math and you pass the substantial presence test, you still might not be a US resident. Why? Because there's a powerful override called the closer connection exception. This is a perfect example of that rule and override framework that defines this whole area of law. So this exception is how you can argue against the pure math of the day counting test. If you were in the US for less than 183 days this year, and you can show that you have a tax home in another country and a closer connection to that country, you can still be treated as a non-resident. It's a way of saying, yeah, the numbers say one thing, but here's where my life is really based. So how in the world do you prove a closer connection? Well, the IRS looks at the whole picture. They're going to ask things like, where's your permanent home? Where does your family live? Where are your personal belongings, your furniture, your cars? Where are your bank accounts? It's all about proving with facts where the center of your life is truly located. And now we come to the top of the pyramid, the highest level of this whole analytical framework, the tax treaty. A tax treaty is basically a special agreement between the US and another country that can literally override the domestic tax laws of both countries, including the green card test and the substantial presence test. This is the ultimate tiebreaker. So what problem do these treaties solve? They solve the dual resident problem. This happens when you're considered a tax resident of the US under its laws, and at the exact same time, you're considered a tax resident of another country under its laws. You can imagine the nightmare. Without a treaty, both countries could claim the right to tax your entire worldwide income. Now, this is a really important and frankly often missed detail. The tiebreaker rules in a treaty aren't a menu you can pick and choose from. It is a strict, sequential process. You have to apply them in this exact order. You start with permanent home. If that's a tie, only then do you move to center of vital interests, and so on, down the list. This strict order is designed to force a clear winner so there's no ambiguity. Okay, let's wrap up with one last real-world scenario that trips a lot of people up. The dual status here. This is what happens when your residency status actually changes partway through the year. Think about someone who arrives on a green card in July, or someone who gives up their US residency and leaves for good in October. So a dual status here means exactly what it sounds like. For part of the year, you are a non-resident, and for the other part, you are a resident. And here's the key. You can't just blend it all together. You are subject to two completely different sets of tax rules for your income, your deductions, everything, for those two different periods, all within a single tax year. Now check this out, because this is a rule that definitely surprises people. The main tax form you have to file for the entire year depends entirely on your status on one single day, December 31st. If you're a resident on that last day, you file a Form 1040. If you're a non-resident on that day, you file a Form 1040-NR. Then you attach a special statement detailing the income from the other part of the year. So, after all that, what's the big takeaway? US tax residency isn't a simple question of where you are. It's a conclusion you arrive at through a multi-layered analytical process. You have to apply the core tests, then check for any exceptions, and finally look for any treaty overrides. And you have to do it in the correct order to land on the right answer. The real question isn't just where are you, but what are you under this very precise legal framework.